Okay, welcome to the Capital Discussions Market Analysis. I'm Tom Nunemaker with Jim Riggio. Before we get started, we're going to go over our disclaimer, which should be loading on your screen. I'll start reading before it loads. Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. Oh, hang on a second. Nice Skype call. Okay, sorry about that. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations, and the risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer is on our website if you want to read it, but for now, I think that'll do. And I will pass the ball over to you, Jim.
I wanted to start off with a technical analysis this week, as we try to start every week, just kind of go over at a high level what we end up seeing from a long-term view and then end up trading, because what I end up thinking is the most effective way to end up trading in a non-directional environment is look at the longer-term trend. And just don't get caught on the other side of it. Stay as neutral as you can. For our directional traders, the strategies that tend to end up working best is to trade with the longer-term trend and then to kind of scalp the sub-trends within it. What you're looking at here is nearly a 3-year graph of the S&P 500 as represented by the SPX. The SPX, and I've taken away all of the oscillators and all of the momentum, and to me right now this is the single most important graph out there. For those of you who like exponential moving averages, okay, the line is in white, the simple moving average, the line is in yellow. You can see it really hasn't mattered too much. We have tested or come close to testing the 150-day moving average multiple times, more than a half a dozen times over the last year. And every time we've come down and touched it or come close to it, we have bounced up and made higher highs. I want to end up just taking what's happened, okay, since the beginning of the summer. You can end up seeing that we've come down. We came close to it, okay, in early August. 3 days ago, we came in and we touched it. And I know that some people like to end up looking at candlesticks and look at the Japanese candlesticks names. Doji, right, Tom? That's what this green bar is right here?
I believe so, yep.
Okay. A doji, okay, or a candle like this is absolutely a great showing. I mentioned this last Wednesday. All right, was it Wednesday or Thursday when we ended up speaking last? It was on the 2nd. We had this very large sell-off to end up only to come back in the afternoon. We came down and we touched the 150-day. It worked perfectly. We bounced off of it and we moved up. I think we continue to end up seeing, okay, until they break this, okay, our trend is back higher at this point. The trade that I put on some time ago that we ended up sharing that I think is a good risk reward, okay, and this is one of these things that, you trade at your own risk, but I looked at a trade that would end up expiring by the end of the year. We made the comment, let me go back to the chart for a second. We made the comment when you end up taking a look at 2000, when we, took a while to end up breaking it, we came off, then we did break it, got a higher than 2000, got up to almost 2020, then we sold off, okay, to almost, approximately 1930, and now we've moved higher again. Granted, we moved higher this morning and then sold off later in the day. But in the bigger trend, this sell-off was extremely healthy. The markets are functioning, okay, with some, I think, reasonable order to them at this point. And like Dow 10,000, for those of you who are old enough to remember it, like Tom and I are, we fought on both sides of that line for years. I think S&P 2000, and I've mentioned this, okay, weeks ago, will have the same type of an effect where we're going to end up fighting it for a while. So it wouldn't surprise me if we end up moving higher and lower. But I think that from one of the risk rewards, one of the trades that I was very, very happy with is a butterfly centered at 2,000 on the SPX. So that's the trade. I made the one that we have on right now. I didn't want to pay a lot of money for it. If I'm wrong, I'm wrong. But when I take a look at this 25-point wide butterfly centered at 2,000, that could go out for a maximum of 25 if we close exactly at 2,000, which, it's, buy lottery tickets if you end up hitting that. I think, but from a risk reward, okay, that we're risking $2.45, let's call it $2.50, can this trade easily move up to $5 or even $10, okay, if in late December going into Christmas we're anywhere, near 2,000? Very, very much so. We like to end up talking about markets, technicals, and then how to end up playing them. If I show you the Thinkorswim graph on that, and what you're looking at here is the P&L for the graph of the butterfly, and each one of these lines is 21 days. So you can end up seeing that for our risk of approximately $250, that if in the last week we move up here. Now here's one of the other things why I love this trade. Volatility always gets pushed down going into December and into New Year's. And it's just a seasonal thing. When I say always, it's just statistically, okay, you have a big advantage of something like that happening. So if we end up moving into anywhere in that range and implied volatility comes down a little bit, we have I think a really nice risk reward, curve. When I put this trade on, because it is only a 25-point wide butterfly on a $2,000 index, I'm prepared to end up losing the entire amount. So this is not a trade where you end up putting a lot of money in, but it's I think, an excellent risk-reward trade. I can go over a lot of other technicals, but nothing shows support the way this 150-day moving average does. Tom, any questions, any comments that we have from anybody?
No comments. I actually put that same trade on, and it's actually up, so I'm pretty happy with it. I took off two of the, I did a 10 lot, took two of the lower pieces off, so it's actually will make money if the market sells off. But it's a good trade. It's nice and stable. Doesn't really change much day to day.
It really is, and one of the things that Tom ended up mentioning, and I'll just end up showing you this real quick. Let's say if I ended up doing 20 contracts, if my opinion, and I don't have one, but if my opinion was bullish, I could end up making this a broken wing butterfly, and maybe what I end up doing is that I end up selling, and I'll do 5 to end up showing what this would end up looking like. If I do 5 less of the upper wings, Tom talked about doing 2 less, and it's always a proportional thing. So I'm doing this 20 times, but I'm only doing the upper wing 15 times. So you can end up seeing that's a nice bullish trade, and if we run up, no matter how far we run up, I'll end up making money. Okay, if I am neutral to say bearish, and I don't think that we're going to get above 2,000, I could end up doing the same thing, and depending on how bearish I am, I could just buy fewer on the downside. And maybe if I buy, again, this is 25% or 5 contracts out of 20, and when I have that up here, it'll look something like, that should have been a 15. It'll look something like this. So you can end up tweaking this trade to whatever your market opinion is. I didn't have one, and I've said for a while that I think there's probably going to end up being some battling, okay, on each side of 2,000. So I think it's a very reasonable trade. I love the fact that it is a seasonal trade, and we're short volatility at the end of the year because vols just get crushed usually after Thanksgiving. The implied volatility and any implied volatilities is being held on to those end of December, or even first, second, third week in January, 10 temps going down. So it's a very flexible trade. I think that by risking one, you could easily, say, make two on something like this, and you probably have a 50-50 chance that at some point you will end up, okay, getting a chance to double or even triple your money to get this $2.50 wide normal butterfly to go up to $5 or $7. So it's I like the fact that it is a defined risk trade. You trade it to whatever size is appropriate for you, with that size, knowing full well, again, that if the market screams in one direction or another, you can end up losing your maximum, and you should be prepared to do that. And so,
do you have any thoughts on any volatility trades that people might be looking at now?
Yeah, if we take a look at what's been going on with the VIX, a couple of things with the VIX. You can end up seeing that we had our spikes in volatility over the last couple of weeks. Every time we've got into this 16 to, I'll call it 20 range over the last several years, we've come back down. You can see that we've made a series of highs in the low 20s for the last 2 years now. So I think that at this season of what's going on, that we probably don't get above that. I think that any spike to the 18 to 20 range, I would be a seller. Here at this range, not really sure. I will end up telling you, when I take a look at the VIX, something that we've shared with you before, I think is a very good trading idea, is that going into expiration, volatilities have seemed to get pushed down the week before. Okay, volatility, we actually have had expirations. If you take a look at them, there have been a lot of those. I think that with the volatility moving up a little bit today, you can see that the VIX was up 91 ticks. We're trading at almost 15 and a half. That we may have, some volatility this week, but next week, especially late in the week, it wouldn't surprise me if we get our normal. Okay, it happens well more than 50% of the time, pushed down in volatility. So one of the things you could end up doing is looking at similar type trades in the VIX. If you wanted to do, again, limited risk type stuff, high multiples of return for low probability, looking at putting on a butterfly or a split strike butterfly around 14. The trade that I might have on here, and it's a little bit wider than I would put on right now, but this was the split strike butterfly that I had put on. Some people might call it a condor because I'm short the 13s and the 15s. So I think that, having some butterfly centered around, 14, 15 area, maybe even the 13 to 15 area, pretty reasonable, okay, trade to play into expiration on a short-term basis. I like those trades. If volatility, okay, spikes up, okay, the most liquid of the volatility ETFs is VXX. if I end up showing you the VXX really quick, you can end up taking a look at that there are some pretty significant implied volatilities. Okay, that's this, and let me move this over here so it's easier to see. Okay, the volatilities, let me come over here, going out on the monthlies is in the 60% range. You can see how the volatilities move much, much higher for puts and calls above the money. So being able to sell some of those volatilities is, I think, a very reasonable thing. I'd never sell them naked, even though they're very attractive to sell them naked. You never know if anything's going to happen where the market just tanks and volatility scream, and this could end up hurting. The one comment I will end up making is that, you know, I've known Tom Sosnoff and Tom Preston for probably about 14 years at this point. Preston has done some really good videos on the VXX, okay, on Tasty Trade, for those of you who are members there. I'd suggest that anybody who ends up trading this, go and listen to the stuff that Tom's put forth. Especially Tom Preston's stuff. He's the one who's done a lot of the technical things. Tom Sosnoff really is a great trader around it, but it's Preston who's done a lot of the heavy-duty math lifting, if you will, explaining how these things work. So I like these products a lot. I like to play their natural decay on them. And then it's however you want to end up playing the decay, whether it's the sell call spreads, whether it's the buy put spreads, whether it's to end up doing, iron condors that lean one way or another. That's the options a trader's choice, if you will.
Very cool. Well, we don't have any more questions, so let's see. Is there anything else for the market analysis portion?
Not really. I mean, I could go through all of the details, but nothing's going to end up showing you as much as this graph. I mean, I can end up walking you through, and I will next week. But for right now, to me, this graph says everything.
Okay. I did want to talk a little bit about a little bit of exciting news. We're going to actually start some trading groups at Capital Discussions, which we figured out a way to make it affordable for us. So, so there will be a small fee where we're talking like $10 a month range, but just to keep basically the bots and the trawlers out and make it a little bit more private. But we should be able to have those ready to go. I'm thinking this week or maybe this weekend at the latest.
Tom, the thing that I'm most excited about this is that, you know, we've spoken to a lot of friends and colleagues who've participated and done a lot of work for different communities. The thing that I'm most excited about our trading groups that we're about to start is that it's going to be a participate or pay model. So for those that are active participants, trading group leaders, okay, the ones who organize things, or trading group advisors, okay, every group will have at least one advisor, maybe two, who are senior level traders who are basically there to end up helping and answering questions. Or people who end up doing presentations. Okay, we're going to end up starting right now. We're just doing our one presentation on Thursday, but we're going to end up opening up for the more senior experienced traders who want to end up sharing. For those that participate and share, there's no fee. That is their contribution. For those that just want to end up watching, well, you know, we do need to pay for the infrastructure. So we do need to collect some nominal fee for the infrastructure. And also, as you mentioned, that keeps it private and keeps it a community. That means we don't have any, bot trollers, looking through our material. It means that we don't have, basically, as I heard one person say, it's good to end up charging a nominal fee just to keep the riffraff out.
There you go. There was a sign in between Grand Forks and Fargo, North Dakota, next to the highway that said, at 50 below, the riffraff goes south. And that's kind of similar with this. A little keep the riffraff out.
So I've spoken to several people. The one that I'm really excited about is that for a long period of time I ran a I participated in. Okay, a trading group, and one of the lead traders, okay, who I did a lot of the work and was just a great participant was Paul Demers. He and I had done a lot of different options trades together, and Paul will be working in a trading group that he and I will end up starting. We're thinking about doing it the same old bat time and bat channel that we used to end up doing it at. We have to end up working out the details, but for those of you who would like to end up participating, we will end up sending out an email. We'll end up starting them, we'll probably, Tom, from an infrastructure point of view, I don't know if we'll start them, the first couple of ones, just make them open to everybody, and then end up asking for those to start to participate. How will the actual infrastructure, what can the people end up expecting to see from the trading groups and from what they'll be asked to either participate or pay?
Well, I haven't built it out yet, but basically the trading groups, if you're participating, then you'll have access to see them on the schedule and join the meetings live, and you'll also have access to recordings. Now, I do have plans to convert all these to streaming format, like I'm doing with the current video. I don't think we have too many that I can't keep up. So hopefully I'll have the streaming, the MP4s, the MP3s, the WebEx files, the whole kit and caboodle, as they say. And that should be all in the library archive searchable. So, if you can't make the meeting, it's still going to be available as a download later, whenever it's convenient for you. And I did paste a link in the chat that's basically got a form just to put your name and email in if you're interested in participating in a trading group. We've already had about a little bit over a dozen people say they want to, and if you're interested, go ahead and join in. The more the merrier.
Great. And Paul, I see Paul Demers is online. Paul, I really look forward to end up getting back to our ways that we were running the group at that point in the when we ran this as a California trading group. It was very, very popular. We all end up doing the same trades. The other thing that we've been asked for, and we are going to end up supporting, there are some people who have trading groups, but they want to keep their trading groups private. Meaning that they're showing their own financials and a little bit more information than they'd want to end up just sharing with the entire community, but with only a small subset. For those folks who want to end up doing that, we're going to make that available to them. They'll have to end up paying their additional WebEx fees, which are going to be modest, but for those groups of whatever it might end up being, I know one group, there are 5 traders, and they constantly communicate. So we're going to end up making that available for them also. And what we're going to also end up doing then is, whether it be Paul initially or others, we're going to end up asking some of those, senior veteran-like traders to come in and kind of share in the community, in the closed community, for anybody who's part of any trading group, that will end up having, whether it be on Fridays or whenever, just a group to be able to end up showing, hey, this is what I'm doing, and this way we can get back to that sense of community. I think a lot of us really loved when we had that sense of community. We contributed, but we also felt that we got a lot out of it. And that's what we want to be able to end up structuring. And I think that, Tom, the way we've structured this, with nominal fees, there's enough money there to pay for the infrastructure, right? Because, we at least need to end up covering our costs to be able to do that. But to me, I'm really excited about that, because that sense of community and helping one another and connecting, traders with one another, I think that's just so important. To me, there was nothing that helped grow me, grow my professional trading career, as it was with speaking with the likes of, a Dan Harvey or a Steve Channon or some of the, a John Locke. And I know that I'm missing, please don't send me the emails. I'm missing, at least, 50 others that, I would end up talking with, and we would end up trading ideas. And I know that it made my trading stronger, made my risk management stronger. So I'm really excited about it.
Yeah, me too. I mean, communities are, trading's a lonely business. You're by yourself, and it's nice to bounce ideas off people. And I've always found the more you give, the more you get back. So you come up with an idea, and then 5 other people take it and run with it farther than you would have gone by yourself. So it's a synergistic thing, and it's awesome.
Yeah, no, it's David, Keith, Paul. I agree with all your comments. I'm really excited about this, and it is so true. I don't know if this has ever happened to you, Tom, but sometimes I've stared at trades and I've analyzed them and I've done everything, and then every once in a while, it might not even be a Stephen Channon, okay, or a Paul Demers level trader coming and asking me a question. It could end up being somebody who's just learned this, have learned the basics, and they said, well, how about this? What happens with your Vega, okay, versus your Gamma when, if the market moves that, some questions like, something I didn't think about that. Hang on, let me go and look again. Oh my goodness, look at this. If I end up doing this, that, I would have gotten hurt, but if I end up putting in this extra put vertical in here, that's going to end up saving a lot of, pain if this happens in the market. So I do think that, there are no, let's face it, there are no, totally unique ideas. When it comes down to it, besides buying or selling a single put, there's only really, two building blocks we have, right? There are verticals and there are calendar spreads. You can buy them, you can sell them, you can buy one, sell another, you can put them in together. But basically, when you think about it, we have 2 Lincoln logs. That's it. Okay, how do we put them together? When do you use which ones? How do certain things get affected? I was speaking with Paul earlier today, and we were talking about skew. What's the implied volatility, let's say, of the 25 delta call versus the 25 delta put? Okay, we can take a look at where the implied volatilities are, because one of the things that Paul, with his trading group, had found was that one of the traders didn't do as well as some of the others, okay, because he was putting the trades on a day where the skew was not helping. It was actually hurting the trade he was putting on. So, you take a look at those types of things, and that's something that one trader may have not known where another one has. Here, it's, I think to myself, it was like, oh, well, what am I going to end up learning? Okay, on the live vol program or the trading at Thinkorswim. And let me show you, I'll just show you one great thing that I learned today from Paul. Okay, we were looking at the VIX. Okay, and if I go and I take studies, I'm going to end up removing all of these current studies. And what we ended up then looking at was the skew. I did not know that you could actually put skew on. Here, let me show skew here first. Right? And this is just the S&P skew, and what it is, it's a single number every day. Let me change my style to make it align so it's easier to see. And go to appearance, and let me make it a line. Now here is the skew, and basically it's just a percentage of what the below the money puts are trading for versus the below the money calls. And what we ended up doing, okay, Paul and I did today when we were talking, is that I came in and I put in a study, and I did a comparison to what happens with the puts versus the call versus, let's just say, the pure old VIX, compare one to the other. And what we ended up doing is that I came in here and I looked at the VIX, made it yellow so it was easier to see. Now here's something that was really interesting. Look at this. When the volatility spikes up, like over here, right? The yellow line is the VIX. When the volatility spikes up, the puts versus the calls got cheaper. Okay, now here's an important thing. What does that mean? What that means is that when volatility goes up, those way out of the money puts and calls don't go up nearly as much as the closer to the money puts and calls. Okay, so the well below the money puts will go up. Their vols will go up without question. But as a percentage, the ones closer to the money go up much more, and vice versa. So if you take a look at this level over here, when the VIX got crushed, okay, in the middle of September, okay, compared to where it was, let's say, in early August, what happened was that those puts well below the money were very expensive compared to at the money. So if you are trading any type of spread where you're buying one option and selling another one, what you're really doing is that you're playing the spread between how expensive one is versus the other. What's the price of the spread? How can you see that? Well, you can look at the implied volatility. You can see what the histories are. There are great charts also on LiveVol. One of the things that I'm excited about is that these are the tools that we use. We don't own our own software company. And we don't have any forum Nazis that are going to say, you're allowed to speak about products A, B, and C, but we won't let you speak about products X, Y, and Z. As I've told everybody, our forums and our community has one rule: respect one another. Okay, if you don't respect one another, we'll throw you off. But if you want to talk about the validity of one product versus the next, knock your socks off. That's what makes us all better traders. That's what we want. We want to have an open and free discussion, an open, free, and respectful discussion with one another.
Absolutely. So I'm looking forward to it.
As am I. We will be sending out an email for the first trading group that we're going to start. Paul and I will team up again the way we used to. I'm really excited about that. Tentatively, we're scheduling it for for Thursday at 9:30 p.m. Eastern Time. That's when our old group used to end up meeting. We just want to make sure that it's not going to be a conflict, and we have to check with a few folks. But once we end up getting all of that in place, we'll be sending out emails to all of you, and you're all invited, and it's all free until Tom gets everything in place. Okay. So there will be, like we end up saying, for those that are going to end up participating, we really want to end up, encouraging participation. Okay, and participation, trading group leaders, trading group advisors, or people who are going to end up doing presentations for the communities on our, senior trader days.
Right.
Tom, anything you want to add?
Well, yeah, the senior trader days, we have to come up with a catchy name for it, but those are only going to be available to people that are paying that membership fee. But again, we want to keep it kind of private, so we don't want, anybody to just troll through, grab it, and then, make a presentation at some brokerage and claim it's theirs. So we want to kind of keep that down. So those special sessions will be only for people who are in our community.
Only in our community, and we want to end up excluding any broker dealers or professionals that would have that ability.
Right.
So, Tom, anything you want to end up adding before we close?
No, I think we've got John Locke coming on Thursday. I know a lot of people know John who are in the room, so it'll be good for them to see John. He's going to be talking about his M3 trade, so I'm looking forward to that. And then we've got John Cusick from Trading Block coming the week after, and then on the 23rd we've got Larry Richards from Quanti Carlo showing off the automated option backtesting software they're working on. So it should be an interesting few weeks coming up.
I'm really excited about it. For and just of the two, I only know John Locke and the folks at Quanti Carlo. John and I participated in a high high efficiency team exercise several years back, and I can end up telling you that John, when it comes to traders, is one of the most sound traders that I know. His mechanics of buying low volatility and selling high volatility in his spreads, and his strategies give you quantifiable edge. Okay, and that's all you can ask for in a trade is, do I have a quantifiable edge so that I have a positive expected return? And by buying lower volatilities, selling higher volatilities, and having good risk management principles that he does is very, very strong. So I really look forward to having John on. And when it comes to Larry Richardson, Quanti Carlo, very, very interesting. I can tell you, okay, I don't think Paul could even count how many hours that dedicated back testing traders like a Paul Demers have gone through. Because once you find a trade that you really, really like, and you've worked on it, then what happens is you want to end up asking all of these what ifs. What if I ended up, selling the 8 delta instead of the 10 delta? What happens if I ended up putting it on at 63 days versus, 54 days? And you end up asking all of these different questions, and every time you change the smallest little variable, you have to go through the whole manual process all over again. And you may want to end up, making just small changes, and it's you have to do everything else. So the amount of work is enormous. The Quanti Carlo model that I've seen, and I've spoken with David and Larry Richards on, ends up letting you automate a lot of that stuff. It'll end up being a paid service that they end up having, but again, I think it's a really nice introduction just to see what's available. We ended up having, we have no bias to trades. All we're looking for is, what are the best available tools out there for all of us, and to have an open discussion, and to allow everybody to make an educated decision about what set of tools or brokerages or anything is best for their trading. So I'm really looking forward to both of those.
Absolutely. All right, well, I don't want to hang everybody up here too long. It's been about 40 minutes, and I think we've pretty much covered everything.
Tom, thank you very much, and I look forward to seeing you guys in the trading group with myself and Paul Demers.
Great. All right, thanks, everyone. I'll hopefully see you on Thursday.
Bye now.
All right, bye.